What's going on, guys? Bexio back, and today we got a brand new video with the first negative GDP print since 2020 coming out, and a recession looming seems unavoidable at this point. What can we do during recession times, during everything going on, to make sure that we get on the other side on the best way possible? It's pretty simple, but pretty hard to follow at the same time because you're going to be wanting to do what's not supposed to be done, and that's just how people act. But this recession is definitely on its way. The GDP print next quarter is going to tell us whether we officially are in one or not, and we're probably going to get into one. But we can look at right here comparing to the stock market. 3 reasons not to worry about a stock market crash. So obviously, with a recession comes a stock market crash. They pretty much go hand in hand with each other. So the first thing here, market crashes are inevitable. Pretty important to know there that crashes happen. They're going to happen. They don't happen often, but when they do, it's usually a great opportunity to get into the market. So this here, just because you don't need to worry about rain doesn't mean you shouldn't have an umbrella. In this case, your umbrella is a portfolio strong enough to make it through unscathed. Doing this involves smart strategies, including investing for the long term and building a portfolio made up of a diverse mix of assets. So, diversity is important in protecting from the downside, but as long as you're invested in great assets, these giant companies that are just proven to be successful, have made it through recessions in the past, no problem. Things like Apple, Microsoft, Google, the tech giants, they might get hit hard during a recession. The stock price might go down by a drastic amount. But on the other side, they're still money printing machines. We still use them every single day in life. So their companies are going to make it through. They've already proven that they can make it through recessions. So these great assets are ones that are just going to be able to make it through and are basically a sale for right now. The biggest thing, if you were not wanting to deal with the volatility and the downside of something like tech stocks, you could easily go with dividend stocks, which handle themselves much better in times like this, where you will not have the immense downside pressure because they pretty much stabilize themselves and then have a bit of passive income from the dividends coming in. Those are usually the types of stocks that perform the best during times like recessions and downtimes in the market. And number two, recoveries always follow crashes. Again, we look at the history of the stock market. Every single time it's gone down, it's made new all-time highs. So that's an important thing as well. A market crash can send your investments plummeting, but just as there has always been crashes, recoveries have always inevitably followed. That is basically what happens. Historically, in the market, at least, every single time it moves down, we see it move up and make a new all time high. So, if it doesn't this time, it'd be the first time in history, and maybe that's a possibility, but it's more than likely that it recovers after recession fears are gone, after these huge interest rate fears and everything going on in the world is gone. Bad news only lasts so long, and then eventually the bad news just becomes we already know that, and it's kind of ignored. So the inevitable rally is definitely something to keep an eye on. And for this, the recovery may take months or even years, but over time, the market has consistently gone up and never experienced a downturn that didn't eventually reverse itself, what we were just saying. So, the stock market, it's always going up and to the right. There's going to be corrections, there's going to be crashes along the way, and it's just going to be usually a sale period for stocks. So, where you can get stocks for a discount, and that's an important thing, is doing the opposite of what you think you should be doing. So, during something like a recession or a crashing market, you're going to want to sell investments and you're going to want to stop investing and hoard cash. And some people do that, but a better strategy for returns and getting assets and accumulating assets and developing wealth is going to be buying these assets, dollar cost averaging in, and just riding it all the way down, continuing to dollar cost average in, because you can't time the market and just buy at the absolute bottom before the rally starts. You're going to end up probably buying on the way up into a rally instead of on the way down, and bringing your cost basis down. So even though every single thing is going to be telling you to sell your investments, take it easy, get safe, and hoard cash, that's not usually the best strategy to developing wealth. And on top of that, if you are going to sell your investments, more than likely it's this crash, it's down 10%, down 20%. Why would you sell there? Why would you sell down 20% if it's a company that originally should be bullish on, that you should enjoy, that you think has long-term potential, and then why would you sell it for losing 20%? You should be buying, saying, this stuff that's happening to the company is outside of its control. It's not happening because, like, Apple's not down because they reported bad numbers. They reported great numbers. They're down because the overall market is in a very tough spot, and it has nothing to do with Apple themselves. That's exactly what happened in 2020. This is exactly what I did in 2020, was stocking up on these giant stocks like Apple, Microsoft, these giant tech companies, because the way I looked at it, when the stocks were crashing, it had nothing to do with the companies and everything to do with outside forces that eventually the market would get over, and Apple was still printing money. Microsoft was still printing money. Everything was going good for them, and fundamentally, nothing was wrong with the company. And you look back from 2020 to now, it's been a really great return for both those stocks. And number 3, you got crashes present buying opportunities. This says, lastly, rather than worrying about a market crash, you should view it as an opportunity. Contrary to what your instincts may tell you, it's a good idea to invest more when a crash occurs. That's what we were just saying. You're naturally going to want to be protective. You're not going to want to get into the market when prices are crashing. You're going to want to get out of it. That's the exact opposite of what you should be doing. Is you should be getting into the market when prices are crashing, because that means you should be getting into great assets when the market's crashing, not just anything, but great assets, the giant companies, the Apples, Microsoft, Googles of the world, even mid-cap companies, blue chip stocks. Those are things you should be really looking to get into, because they're going to be the best on sale, because they're going to be at levels they shouldn't be at because of the companies they are. So that's something to think about. And then this also, you don't necessarily want to try to time the market to buy at rock bottom prices, since you can't always tell exactly when the crash will end and recovery will begin. So if you consistently buy stock as prices fall, it's inevitable that you will buy some shares at an opportune time and see more profit because of it. That's just what you want to do. Don't try and time the market. Timing the market is basically impossible. So you want to dollar cost average your way down. If something falls 5% and you just keep investing your money, and it falls another 5, you just keep investing your money. And that is something that you just continue to do. You continue to do your normal average routine, investing ordinary, investing every week, every month, whatever the DCA is, and just kind of go on with your day and make sure it's a number that you don't have to worry about, and that you're not going to have to check the portfolio every single day and say, oh, I hope it doesn't fall down. It shouldn't be rent money, shouldn't be grocery money, any of this stuff. It should be extra money that you can afford to let sit in there for multiple years and for a long term, and ride this all out. And to end this article off, saying, what should you do instead of worrying? First and foremost, don't invest anything you wouldn't be prepared to hold through a down run. We just said that. Should be extra money, something that you can put in there and just let it sit there for multiple years. Second, aim to have some cash available to invest when a crash happens, so you have the opportunity to take advantage of discounts in companies you believe in. This one, that's like hoarding cash. I don't know if I would super agree with that. You don't necessarily want to hoard cash. There's times when maybe you do that because, like in 2020, a lot of people hoarded cash, but the people who didn't get into the market and just kept hoarding cash and said things are just going to be terrible, they ultimately sat on the sideline and watched a historic run and weren't able to be involved in it. So I think instead of that, you should just continue dollar cost averaging, do nothing special, and just make sure you have enough cash to have your emergency fund and bills paid for. That's what you really need. And third, never panic sell, because doing so just locks in losses. On top of that, I mean, you'd never panic sell because ultimately, if you're panic selling, you're at a very fearful time in the market. The prices are already down massively. Why would you sell when the prices are down? If Apple falls 20%, why are you going to sell Apple at negative 20%? That just doesn't make any sense. You should be buying Apple for that price, because nothing happening to the company is Apple's own fault. They're not reporting bad numbers. It's just the overall market is fearful and bad things going on. So eventually, the fear runs out, the fear goes away or becomes old news, and people go back to looking at Apple and saying, this is dirt cheap for Apple. They just had $100 billion quarter. And then the stock price reflects the non-fear in the market again. So with investing and crashes and recessions, so many fearful events going on. We saw obviously 2020, lots of fear going on. The market crashed. And from that crash, it recovered to new all-time highs, to a massive rally that was unseen before. And a lot of people were shocked at how much the rally was. But that just goes to show these crashes are temporary. Every single time in history there's been a crash in the market, it has recovered and made a new all-time high. Now, this one we've been in for 4 months, basically since the beginning of the year, maybe even a couple months before that. We might have been into this crash for 6 months at this point. And there's not really a Fed to come bail us out. They're fighting inflation and stuff. So this one might take longer to recover, might take a year, a year and a half. Usually recessions last like 6 to 18 months. So we could be looking at that happening. And then after that period, when recession is starting to get over, GDP is climbing again, everything's looking better. The fear leaves the market and the market continues to start to rally. And then last thing to mention is when stocks are down massively and they have massively bad days, usually those are followed by insane green days and rallies in which if you miss those days, your returns get absolutely devastated. So that's why you don't want to try and time the market, sell out, buy in. It's just not worth it. You should be buying great assets and holding them for the long term. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And I'll see you guys in my next video.